In the UK, 87% of investors are currently holding onto a toxic asset that's quietly draining their wealth. And it's linked to a specific chip giant that's now under federal investigation. This isn't just a minor setback. We're talking about a potential loss of £14.2 billion in the European market alone. Will the European Central Bank's latest move be enough to mitigate the damage? Or is it already too late? The recent probe into the chip giant's financial dealings has uncovered some disturbing patterns, particularly in cities like London, where major financial institutions like HSBC and Barclays have significant stakes. The mechanism involves complex trades and shell companies, all designed to obscure the true nature of the transactions, which has led to an estimated 23% decline in investor confidence across Germany and France. What role do you think the Swiss banking system has played in enabling these questionable practices? A case study of the Canadian market reveals that investors who diversified their portfolios with a mix of US and European stocks have seen an average return of 12% over the past year. But those who put all their eggs in the chip giant's basket have lost a staggering 35%. For instance, in Toronto, a significant number of investors have reported losses exceeding $100,000. Can you guess which specific type of investment is now being touted as the safest bet for 2025? Despite its history of volatility, behind the scenes, a hidden mechanism is at play, one that nobody explains to the average investor. The practice of naked short selling, which has been linked to the downfall of several major companies in the past decade, including a notable example in Frankfurt. This has resulted in an estimated 17% decrease in overall market value. How many times have you unknowingly fallen victim to this practice? And what are the chances that it could happen again in the next 12 months? The psychological dimension of this crisis is just as fascinating as it is terrifying. Why do people stay trapped in a cycle of toxic investments, even when the writing is on the wall? The answer lies in the realm of cognitive biases and the fear of missing out, which has been particularly prevalent among investors in Paris. For example, a recent survey found that 42% of investors in the city admitted to making impulsive decisions based on emotions rather than logic. What is the one mindset shift that could save you from this trap? And how can you apply it to your current investment strategy? Wealthy individuals think differently about risk and return. They understand that true wealth creation involves taking calculated risks and diversifying across different asset classes, as seen in the investment portfolios of high net worth individuals in Zurich. For instance, a study found that the top 1% of investors in the city have an average of 25% of their portfolios allocated to alternative assets. How do they balance their portfolios to maximize returns while minimizing exposure to toxic assets, like the chip giant? To safeguard your wealth, take these 3 specific steps. Open a diversified index fund account with a reputable platform like Vanguard or BlackRock. Allocate at least 15% of your portfolio to European bonds. And consider setting up a tax-efficient retirement account in a country like Ireland. What are the potential tax implications of this strategy? And how can you mitigate them? If you are still watching, you already think differently from 95% of people. Most people will watch this and do nothing. You are not most people. Press like. It takes 1 second and helps more people find this truth. Subscribe. Because tomorrow I am covering something that will make today look like a warm-up. I will see you there.